Germany is deindustrializing in real time. Factories closing. Energy costs 10 times higher than competitors. Chinese manufacturing undercutting on price. The largest economy in Europe is in its third technical recession in 4 years. And when Germany falls, the entire European Union falls with it. Right now, Volkswagen is closing factories in Germany for the first time in its 87-year history. BASF, the world's largest chemical company, is moving production to China and the United States. Siemens is cutting tens of thousands of jobs. ThyssenKrupp, steel manufacturer for over 200 years, is on the verge of bankruptcy. The German Institute for Economic Research published data in December 2024 showing industrial production down 18% from 2018 levels. Not a cyclical dip. Structural decline. Manufacturing, which represents 23% of German GDP, is contracting for the 5th consecutive year. This collapse accelerated precisely when energy prices spiked after cutting Russian gas supplies in 2022. The probability of Germany's industrial base surviving without cheap energy while competing against China and the US with energy advantages is approaching zero. This is the pattern of Britain in the 1970s. Dominant industrial power loses competitive edge, refuses to adapt, clings to old industries and old methods. Result is decades of decline and loss of global relevance. Germany is following the exact same trajectory. Wolfgang Münchau, economist and columnist, stated in January 2025, Germany built its economic model on 3 pillars: cheap Russian energy, Chinese export markets, and advanced manufacturing. All 3 are gone. And there's no plan for what comes next. Even more alarming, Germany's political system is paralyzed. Coalition government collapsed in November 2024. Elections scheduled for February 2025 produced fragmented parliament, no clear majority, policy gridlock. While the economy burns, politicians argue about coalition partners and cabinet positions. The assumption that Germany's industrial dominance was permanent because of engineering excellence and quality manufacturing broke completely when energy costs, competition, and geopolitical shifts made the business model unviable. Here's what should terrify every European. Germany is 30% of EU GDP. They're the economic engine funding EU budgets, bailing out southern European countries, driving European growth. When Germany enters sustained recession, there's no one left to carry Europe. Italy can't. France won't. And the EU project built on German prosperity faces existential crisis. Think about that. Before we break down exactly how Germany went from Europe's powerhouse to industrial decline, why energy costs destroyed competitiveness, what China's manufacturing dominance means for German exports, and why this crisis takes down the entire European Union. If you want to understand the most important economic story in Europe that mainstream media is completely ignoring, hit that subscribe button and turn on notifications. Because what we're revealing will change how you see European economic stability, and why betting on EU growth is betting on a collapsing foundation. Leave a comment. Can Germany reverse deindustrialization, or is decline inevitable? Will the EU survive without German economic strength? And which country benefits most from Germany's industrial collapse? Let's start with what actually happened to cause this collapse, because the narrative that it's just about energy prices misses the deeper structural problems. Germany's economic model was built on specific competitive advantages. First, cheap energy from Russia. Natural gas pipelines delivering reliable supply at $3 to $4 per million BTU. German chemical plants, steel mills, automotive factories, all designed around energy costs at that price. Second, export markets in China. Germany exported machinery, cars, chemicals to China, $200 billion annually. China was Germany's largest trading partner. German manufacturers built factories in China, transferred technology, trained Chinese engineers. The assumption was this partnership would continue indefinitely. Third, advanced manufacturing capability. German engineering, precision, quality. The brand value of Made in Germany. Premium products commanding premium prices globally. This was supposed to be the unassailable advantage. All 3 collapsed simultaneously. Start with energy. February 2022, Russia invades Ukraine. Europe imposes sanctions. Russia retaliates by cutting gas supplies. Nord Stream pipelines, which carried 55 billion cubic meters annually, are sabotaged in September 2022, permanently destroyed. Germany pivots to liquefied natural gas imported from United States, Qatar, other suppliers. but LNG costs 3 times more than pipeline gas. Currently, European natural gas prices are around $30 per million BTU. US prices are $3, 10 times difference. For energy-intensive industries, this is catastrophic. BASF's chemical plant in Ludwigshafen uses as much energy as the entire country of Denmark. When energy costs triple, the plant becomes uncompetitive. BASF announced in 2023 they're permanently reducing European production and expanding in China and the US where energy is cheap. ThyssenKrupp, steel manufacturer, can't compete when energy for blast furnaces costs 10 times what competitors pay. Steel from China, from the US, costs less delivered to Europe than ThyssenKrupp can produce domestically. The German Chemical Industry Association estimated that 1/3 of chemical production capacity will leave Germany permanently, not temporarily. Permanently, because the investments are being made in other countries and won't return. Now, let's talk about China. Germany's export model depended on selling to China, but that relationship fundamentally changed. In 2000, Germany was technologically superior to China. German machines, German cars, German chemicals were better than anything China produced, so China bought German. In 2024, China is peer competitor or superior in most sectors. Chinese EVs are better and cheaper than German EVs. BYD outsells Volkswagen in EVs globally. Chinese machinery rivals German quality at half the price. Chinese chemicals are catching up. Germany exported $170 billion to China in 2023, but imported $190 billion from China. Trade deficit of $20 billion. That's a reversal from historic surpluses. Germany is losing the Chinese market while simultaneously being undercut by Chinese competition in third markets. Volkswagen is a perfect case study. They generate 40% of sales from China, built 25 years of market dominance. Now Chinese EV makers are destroying them. VW's China sales fell 16% in 2024, market share declining. And unlike in Europe, where VW can lobby for protectionist measures, in China they have no leverage. VW announced in October 2024 they're closing 3 factories in Germany. First factory closures in company history. They're not closing Chinese factories. They're closing German factories. Because the business is in China even though VW is losing market share there? This is the deindustrialization feedback loop. Lose competitiveness. Close domestic factories. Move production to where it's viable. Domestic economy shrinks. Tax base shrinks. Government revenue falls. Can't invest in competitiveness. Further decline. BMW and Mercedes are facing identical pressures. 40 to 50% of sales from China. Chinese EV competition intensifying. Losing market share. Profitability collapsing. And the solution is to cut German production and expand where labor and energy are cheaper. The German automotive industry employs 800,000 directly and 2 million indirectly in suppliers. If this industry shrinks by 30 to 40% over the next decade, that's 600,000 to 800,000 jobs disappearing. Now let's talk about the political response because it's making everything worse. Germany's coalition government, led by Chancellor Olaf Scholz, collapsed in November 2024. The issue was fiscal policy. Scholz wanted to increase spending to address industrial crisis and infrastructure decay. The Free Democrats, coalition partner, refused to violate Germany's debt brake constitutional rule limiting deficit to 0.35% of GDP. Coalition broke apart. Elections held in February 2025. Result was fragmented parliament. Christian Democrats got 28%, Social Democrats 24%, Greens 14%. Alternative for Germany, right-wing party, got 22%. Free Democrats 12%. No clear coalition majority. Negotiations lasted 2 months. Finally, in April 2025, a grand coalition formed between Christian Democrats and Social Democrats. But policy compromises are so watered down that nothing substantial can pass. The debt brake remains in place. Infrastructure investment remains inadequate. Energy policy remains incoherent. Industrial policy is non-existent beyond symbolic subsidies. Meanwhile, the United States passed the Inflation Reduction Act with $370 billion in subsidies for green technology and manufacturing. China subsidizes industries at even larger scale. Germany, constrained by constitutional debt limits and EU state aid rules. German companies are responding rationally. They're investing where the subsidies are. Volkswagen is building battery plants in the United States to qualify for IRA tax credits. BASF is expanding in China, where energy is cheap and government support is generous. Siemens is shifting R&D to where talent and incentives align. This is industrial policy failure. The government isn't competing for business. It's losing business through inaction. Now let's talk about energy policy specifically, because this is where Germany made catastrophic mistakes. In 2011, after Fukushima nuclear disaster in Japan, Germany decided to phase out nuclear power. Energiewende, energy transition. The plan was to replace nuclear with renewables, primarily wind and solar. By 2022, Germany had shut down all but 3 nuclear plants. Those final 3 were scheduled for closure in 2023. Then the energy crisis hit. Germany faced winter without Russian gas and without nuclear baseload power. The government extended the 3 remaining nuclear plants for a few months, then shut them down in April 2023. Now Germany has 0 nuclear power despite facing energy crisis. France generates 70% of electricity from nuclear. Energy costs are half of Germany's. French industry isn't facing the same crisis. German decision to shut down nuclear while facing energy crisis is one of the worst policy decisions in modern European history. It's ideologically driven, not economically rational. And renewables can't fill the gap. Wind and solar are intermittent. You can't run a chemical plant or steel mill on intermittent power. You need baseload. Coal is being phased out for climate reasons. Nuclear is shut down. Natural gas is expensive and imported. There's no solution. Germany is building LNG terminals. 7 terminals under construction. But LNG will always be more expensive than pipeline gas was. And the infrastructure to use LNG instead of pipeline gas requires retooling factories, billions in investment. Some companies won't invest. They'll just leave. The Kiel Institute for the World Economy estimated that Germany's potential GDP growth rate fell from 1.5% to 0.7% due to energy crisis alone. That's structural, not cyclical. Permanent reduction in growth capacity. Now let's talk about demographics because this compounds everything else. Germany has aging population. Median age is 48. Birth rate is 1.5 children per woman. Need 2.1 for replacement. Workforce is shrinking. From 2020 to 2030, working age population declines from 54 million to 51 million. 3 million fewer workers. In manufacturing jobs, the decline is steeper because younger generations don't want factory jobs. Germany tried to address this with immigration. Welcomed 1 million refugees in 2015-2016. But integration into workforce was slower than expected. Language barriers, skill mismatches, cultural integration challenges. By 2024, labor force participation among refugee population is only 54% compared to 78% for native Germans. So the demographic fix isn't working. Aging population also means rising pension and healthcare costs. Government spending on elderly increases. Spending on infrastructure and industrial policy decreases. Resources shift from growth to maintenance. This is the Japanese trap. Aging demographics, declining workforce, rising social costs, stagnant growth, increasing debt. Germany is following Japan's path, but without Japan's high savings rate and export surpluses to cushion the decline. Now let's talk about what this means for the European Union, because Germany's crisis is Europe's crisis. Germany contributes approximately 25 billion euros annually to the EU budget. That's 20% of total EU budget. They're the largest net contributor by far. France contributes 10 billion, Netherlands 6 billion, everyone else much less. If Germany enters sustained recession, their contribution falls, but EU commitments don't fall. Cohesion funds to Eastern Europe, agricultural subsidies, green transition funding, all committed. The gap has to be filled by other countries, or the EU has to cut programs. Other countries don't want to pay more. Germany is already resentful about funding Southern Europe. If German economy is struggling, political support for EU transfers collapses. This is the EU budget crisis that's coming. Without German economic strength, the EU can't fund its ambitions, can barely fund its existing commitments. There's also the question of euro stability. Germany's economy is the anchor of the Eurozone. If Germany is in recession while Southern Europe needs stimulus, the European Central Bank faces impossible choices. Raise rates to fight inflation in Germany? That kills Southern Europe, which is already weak. Lower rates to stimulate Southern Europe? That worsens inflation in Germany. The Eurozone is designed for economic convergence, but Germany and Southern Europe are diverging. Italy has debt to GDP of 140%, Spain 115%, Greece 180%. These countries can't survive higher interest rates. But Germany can't survive continued inflation from loose monetary policy. The ECB is trapped. And without the political integration to make fiscal transfers, the euro system is structurally unstable when the largest economy is in crisis. Some analysts argue the euro will break apart in the next crisis, Germany will exit, or southern countries will be forced out. This seemed extreme until recently. Now it's being discussed seriously by economists and policymakers. Let's talk about defense spending because this adds another dimension. Germany committed to spending 2% of GDP on defense after Russia invaded Ukraine. That's approximately 70 billion euros annually, but Germany is barely spending 1.5%, about 50 billion. To reach 2% requires 20 billion more annually, but the debt brake constrains spending. So either Germany violates the debt brake, cuts other programs, or doesn't meet defense commitments. Chancellor Scholz proposed a special defense fund outside the debt brake. Constitutional Court is reviewing if that's legal. If the court says no, Germany can't reach 2% without violating constitutional rules. The United States is pressuring Germany to spend more on defense. Trump threatened to withdraw security guarantees if European allies don't meet commitments. Germany is caught between fiscal constraints and alliance obligations, and defense spending crowds out industrial policy. If Germany allocates 20 billion more to military, that's 20 billion not going to subsidize green technology or infrastructure or industrial competitiveness. This is the fiscal trap. Need to spend on defense, pensions, healthcare. Can't because of debt limits. Economy weakening, which reduces revenue. Structural decline accelerating. Now let's talk about specific industries and what's happening in each. Automotive is the most visible. Volkswagen, BMW, Mercedes all facing Chinese EV competition. European EV sales growth stalled in 2024. Consumers don't want expensive EVs. Chinese EVs are cheaper but face tariffs. German EVs are expensive and losing market share. Volkswagen's profit fell 36% in first 9 months of 2024. BMW down 14%. Mercedes down 27%. These are not cyclical declines. These are structural competitiveness problems. VW's decision to close German factories is historic. But it won't be the last. BMW is reviewing production footprint. Mercedes is cutting costs aggressively. More factory closures are coming. Chemicals is equally bad. BASF is the bellwether. They announced permanent reduction of European capacity, shifting production to China and Louisiana. High energy costs make European production unviable for most product lines. Smaller chemical companies are shutting down entirely, selling assets, exiting markets. The German Chemical Industry Association estimates 15 to 20% of production capacity has left or will leave Germany by 2027. Steel is facing terminal decline. ThyssenKrupp tried to merge steel division with Tata Steel. Deal fell apart. Now looking for any buyer. Likely outcome is Chinese acquisition at fire sale prices. German steel industry, which once supplied the world, will be Chinese-owned. Machinery and industrial equipment still competitive but losing ground. Chinese machinery improving rapidly. German quality advantage narrowing. Price disadvantage widening. Market share in developing countries already lost. Fighting to maintain position in developed markets. Only sector performing well is software and services. SAP, German software company, is thriving. But services can't replace manufacturing employment. Factory worker losing job can't become software engineer. This is the structural shift. High-value manufacturing leaving. Can't be replaced by services at same employment levels. Result is economic decline and social instability. Now let's talk about social and political consequences, because economic decline doesn't happen in vacuum. Alternative for Germany, right-wing party, got 22% in February 2025 elections. In some Eastern German states, over 30%. Their message is simple. Immigration is destroying German prosperity. EU is taking German money. Establishment parties are failing. It's economically wrong. Immigration isn't causing deindustrialization. Energy policy, Chinese competition, and structural changes are. But the message resonates because people need someone to blame. Mainstream parties are losing credibility. Christian Democrats governed for 16 years under Merkel, presided over the decisions that led to current crisis. Social Democrats are in coalition but can't deliver results. Greens are blamed for energy policy failures. Political fragmentation is increasing. 5 or 6 parties in parliament. Coalition building is harder. Policy is watered down to get agreement. Nothing bold can be done. Some German economists are calling for suspension of the debt brake. Emergency economic measures. industrial policy on scale of IRA in the US. But political system can't deliver that. Constitutional court would block it. Free Democrats would leave coalition. Public opinion is divided. So Germany muddles along without decisive action while the economy continues declining. The social consequences are rising. Youth unemployment is low in Germany, but underemployment is rising. University graduates taking jobs that don't require degrees. Wage growth is stagnant. Cost of living is increasing. Surveys show young Germans are pessimistic about the future. Don't expect to achieve living standards their parents had. Don't believe pensions will be there when they retire. Considering emigrating to United States, Canada, Australia, where opportunities seem better. This is the death spiral of confidence. Economy declining, politics dysfunctional, people losing faith in the system, best and brightest leave, further weakening the economy. Now let's talk about whether this is reversible, because some argue Germany can adapt and recover. The optimistic case is Germany still has strong fundamentals, skilled workforce, good infrastructure, strong institutions, rule of law. If energy prices stabilize and China relationship improves, German manufacturing can recover. But this ignores the structural changes. Energy will never be as cheap as Russian gas was. China won't go back to being dependent on German imports. They have their own industries now. Technology is also shifting away from Germany's strengths. Internal combustion engines were German engineering excellence. EVs are simpler. Chinese can make them as well or better. Industrial machinery was German precision. Now it's software and AI. Chinese are matching or exceeding Germans. The world moved on, and Germany didn't adapt fast enough, clinging to old industries, old business models, old assumptions about competitive advantages. Can this be reversed? Only with radical changes, massive investment in new technologies, AI, quantum computing, biotechnology, sectors where Germany isn't behind yet, but that requires government industrial policy, subsidies, tax incentives, research funding, infrastructure investment, all constrained by debt brake and EU rules. It also requires education system reform. Germany's apprenticeship system is excellent for traditional manufacturing, but doesn't produce enough software engineers, AI researchers, biotech scientists. The system needs to shift, but systems don't shift quickly. Most realistic scenario is gradual managed decline. Germany remains wealthy by historical standards, but loses global industrial leadership, becomes more like France or UK. Large economy, good living standards, but not the powerhouse it was. For some Germans, this is acceptable. For others, it's national failure. The political debate will rage, but the economic trajectory is clear. Decline is underway. Reversing it requires changes Germany seems unable or unwilling to make. Now let's talk about who benefits from Germany's decline, because in economics, one country's loss is another's gain. United States benefits. German companies moving production to the US. BASF expanding in Louisiana. VW building battery plants in Tennessee. Jobs and investment flowing to America. IRA subsidies working exactly as intended. China benefits. German companies investing in China. Technology transfer continuing. Chinese companies taking market share from German competitors in third markets. Germany declining strengthens China's position as global manufacturing leader. Poland and Eastern European countries benefit modestly. Some German production moves to Poland for lower labor costs while staying in EU, but this is small compared to outflow to US and China. France doesn't benefit much. They have own structural problems, and German decline weakens the entire EU, which hurts France. Southern European countries hurt. Germany's economic weakness means less appetite for fiscal transfers. EU budget will be tighter. Funding for cohesion programs will decline. For global economy, Germany's decline is net negative. Less trade, less investment. More instability in Europe. The second largest developed market in the world shrinking is bad for everyone, but the shift is unstoppable without major policy changes, and those changes aren't happening. Now let's talk about timeline, because the question is, how fast does this happen? We're not talking about Germany collapsing in 2 years. This is a decade-long decline. From 2024 to 2034, Germany's industrial output could decline by 25 to 30%. GDP growth averages 0.5% or less. Per capita income stagnates or declines slightly. This is the British disease from 1970s and 1980s, slow decline. Living standards deteriorating gradually, young people leaving, brain drain, industries shutting down one by one. Takes decades, but the endpoint is clear. By 2035, Germany might look like UK does today, still wealthy by global standards, but no longer an industrial power. More service-based economy, financial services, tourism, software, but not the manufacturing engine that defined Germany for a century. Some specific predictions for next 5 years, 2025-2026, more factory closures announced. Volkswagen, BASF, ThyssenKrupp all shed capacity. Unemployment rises from 3.5% to 5%. GDP growth negative or barely positive. 2027-2028, political crisis as coalition government struggles. Possible early elections. Rise of alternative for Germany continues. Mainstream parties lose further ground. EU budget negotiations become hostile as Germany reduces contributions. 2029-2030. Energy prices remain structurally high. Some stabilization but nowhere near pre-crisis levels. Manufacturing continues leaving. Service sector tries to compensate but can't fully offset. Germany's GDP share of Eurozone falls below 25% for first time since Euro creation. This isn't inevitable if policy changes dramatically, but given current trajectory and political constraints, it's the most likely path. If this breakdown of how Germany went from Europe's industrial powerhouse to economic decline, why energy costs destroyed competitiveness, what China's manufacturing dominance means, and why this collapse takes down the EU, changed how you see European economic stability, hit that like button and subscribe. We're tracking every factory closure, every policy failure, every sign that Europe's economic engine is dying. Leave a comment. Can Germany reverse deindustrialization, or is decline inevitable? Will the EU survive without German economic strength? Which country benefits most from Germany's collapse? Share this with anyone who thinks Europe is economically stable or that Germany will remain an industrial leader. After this, they'll understand why Europe's largest economy is following Britain's path from the 1970s, and why that matters for global trade, EU stability, and every portfolio with European exposure.